In 2021 alone, 5 buy now, pay later companies issued 180 million loans in the United States, up from just 16.8 million as 2 years earlier. Every one of those loans was marketed as completely interest-free. So here's the question worth asking. How does a company make real money handing out free loans at scale to a huge share of American shoppers? The total value of these purchases hit an estimated $70 billion in 2025 alone. Somebody, somewhere, is paying for all of this, and it's usually not who you'd expect. Today we follow the money through buy now, pay later, using data from the Federal Reserve and the CFPB, with the sources on screen the whole way through. Let's get into it. First, the setup, because it's different from a credit card in one important way. With a credit card, the bank lends you money directly and you pay them back. With buy now, pay later, there's a third player, the retailer. You buy something, split it into 4 payments, and the BNPL company pays the merchant the full amount upfront minus a fee. You then pay the BNPL company back over about 6 weeks. Notice what just happened. The retailer got paid immediately and took on zero risk. The BNPL company took on all of it. And critically, on the standard 4-payment plan, most providers don't run a hard credit check and don't report anything to the credit bureaus, which means the loan feels invisible to you and to anyone else trying to see your full financial picture. Keep that in mind. It matters later. Pillar 1, and by far the biggest one, merchant fees. When a retailer offers buy now, pay later at checkout, they pay the BNPL provider a cut of every sale, and according to the Federal Reserve, that cut runs 5 to 8%. Compare that to a typical credit card interchange fee, which we covered in our last video, around 2 to 3%. Buy now, pay later fees can run more than double what card networks charge. So why would any merchant agree to that? Because it works. Businesses that offer these plans see measurably higher conversion rates and bigger average orders. One widely cited study put the revenue lift at 14%. A $200 cart becomes easier to say yes to when it's framed as 4 payments of $50. So merchants pay the premium because splitting the price makes people spend more, not less. And just like the credit card rewards we covered last time, that fee doesn't just vanish. Retailers build it into the shelf price. Everyone shopping at that store is quietly paying a little more, whether they use buy now, pay later or not. There's actually a name economists use for this: price discrimination. The merchant charges full price to shoppers who will pay it outright and effectively subsidizes a short interest-free loan for shoppers who are more price-sensitive, because getting that second group to buy it all is worth the fee. That's pillar 1, and it's the quiet one. You never see this fee, not on a single receipt. The next pillar, you actually might, because not everything in this industry is actually interest-free. Pillar 2, interest. And this is the part of the industry that gets the least attention because the marketing works so well. The classic pay-in-4 plan really is interest-free, but most of the big providers now also offer longer financing. Affirm has plans running up to 36 months. Klarna offers what it calls pay-in-3 and fair financing, and Zip has rolled out an 8-payment option. These longer plans are loans in the fuller sense. They carry a real, disclosed annual percentage rate, sometimes comparable to a credit card's. So the interest-free branding that built this entire industry's reputation quietly stops applying the moment you choose a bigger purchase or a longer payment window. Most people don't clock the switch because the app looks and feels identical to the interest-free version they're used to. Same checkout screen, same familiar layout, except now there might be 8 installments or 12 and a percentage sitting quietly in the terms. This is where buy now, pay later stops being a clever payment tool and starts being functionally a regular loan, just one that still gets marketed with the word free attached to it. And there's a second business quietly riding along on top of all this data. Klarna, for one, doesn't just collect merchant fees. It uses its purchase data to sell advertising, run its own product search engine, and take a cut through affiliate marketing. Your shopping history isn't just a record. For at least one major player here, it's a second product. Pillar 3, what happens when you miss a payment, and a bigger structural risk underneath all of it. Late fees vary a lot by provider. Affirm advertises that it never charges one, Afterpay caps them, but others charge a flat fee or a percentage of the missed installment every time you're late. On their own, these fees are the smallest pillar. But here's the number that actually worries regulators. According to the CFPB, 69% of buy now, pay later borrowers were also carrying a revolving credit card balance at the time they were surveyed, at an average interest rate of 25.2%, the same number from our last video. And BNPL borrowers were 11 percentage points more likely to have a payment at least 30 days late compared to people who don't use these plans at all. Remember how these loans mostly don't report to credit bureaus? That means someone can take out 4, 5, 6 of these loans across different apps in the same week, and none of those companies can see the others. Picture it concretely. 5 $50 pay-in-4 plans, taken out the same week across 5 different apps. Feels like 5 small, manageable, $50 decisions. It's actually a $250 obligation due in 2 weeks, split across 5 separate companies who have no way of seeing what the others already know. Each individual payment looks small. The total, stacked across every app, often isn't. Starting later this year, credit scoring models are finally set to begin factoring buy now, pay later activity in, which tells you regulators already see this as a real, developing risk, not a hypothetical one. So, 3 pillars: merchant fees, the biggest one invisible to you, and higher than what credit cards charge, quietly baked into the price of everything you buy at a participating store. Interest, hiding behind the interest-free branding the moment you pick a longer plan. And late fees, small individually, but sitting on top of a debt-stacking risk that most of these apps are structurally designed not to reveal to each other. None of this makes buy now, pay later evil exactly. Used exactly as intended. One short plan, paid on time, for something you already budgeted for. It can genuinely be interest-free. The problem is what happens when small payment now becomes the only math you're doing, instead of total cost, across everything you're currently juggling. If this made another corner of the checkout screen a little less invisible, that's what this channel is for. Money, explained with the receipts on screen, not vibes. Next video, we're going back to the source everyone assumes they already understand. Your own bank. Why does it pay you basically nothing on your savings while charging you 20 times that to borrow? Subscribe so you don't miss it. See you there.